Hello everyone. Today we are diving into investing and financing activities. This is a crucial component of the statements of cash flows. So these sections reveal how a company uses and obtains long-term funds. Understanding this distinction is going to be key for your CPA exam success. Let's get started. Let's start with a quick recap. We already covered operating activities. If you have not yet, I recommend you watch the first two videos. So operating activities, as you remember, deals with two day-to-day businesses. Now we are moving into the other two vital sections. We will focus on the investing and financing activities, which shows how a company manages its long-term assets and capital structures. And this structure helps us to categorize every cash transactions. Now let's zoom into them. Okay, so what are the investing activities? They are all about growing the business through non-current assets. Think of these transactions that acquire or dispose long-term resources. So this includes things like property, plant, and equipment, or investments in other companies. It also covers lending money to others, which creates notes receivable. These activities are distinct from daily operations and financing. So let's look at the specific cash inflows from investing. These are the sources of cash that come from long-term asset transactions. When a company sells land, buildings, or equipment, that's all the cash that comes in here. So similarly, selling investments in other entities like stocks or bonds generates an investing inflow. And when a company collects the principal on loans it made to others, that's also investing inflow. Now let's explore the cash outflows related to investing. Okay, so conversely, investing outflows represent the use of cash for long-term assets. When a company buys property, plant, and equipment, that's a cash outflow for investing. Purchasing investments in other companies like their stocks or bonds also falls into this category. And when a company lends cash to others, that disbursement of the principal is an investing outflows. And this helps us how a company is allocating its capital for future growth. Now we'll shift our focus to financing activities. What are the financing activities? They are all about funding the business, how the company gets and uses its capital. And these transactions involve a company's liabilities and equity, showing how it funds its operations. So we are talking about big picture of where the money comes from to run the business. Think of it as the company's financial backbone. We will explore how companies raise money through debt and equity. Next, we will dive into specific ways cash flows into the business from those financing efforts. Okay, so the financing inflows are the cash coming into the business from its funding sources. These are the ways a company brings its capital to grow or maintain operations. The two main ways are by issuing debt or issuing equity. When a company issues bonds or takes out long term, it receives cash. Similarly, it sells common or preferred stock. Cash inflows from investors. These inflows are crucial for a company's financial health. Now let's look at the flip side. How a cash flows out through financing activities. Financing outflows represent the cash a company uses to pay back its creditors and owners. Okay, so I'm repeating this. Financing outflows represent the cash a company uses to pay back its creditors and owners. These are the payments made related to the capital raise. Key outflows include repaying the principal on bonds or notes, buying back the company's own stock, known as treasury stock, and paying back dividends to shareholders. It's important to distinguish these from the operating activities. And this leads us to common exam trap that often confuses the candidates, the difference between interest and dividends. Here's the classic CPA exam trap. Classifying interest paid versus dividends paid. This distinction is critical for the statement of cash flow. So interest paid is always an operating activity because it's an expense that impacts the net income. But dividends paid are financing activity. Dividends paid is a financing activity because they are distribution of the earnings to shareholders. So they are not an expense. So don't mix these up. It's a frequent test point and they love to ask this one. Next, we will discuss non-cash investing and financing activities and their disclosure requirements. Some significant investing and financing activities don't involve cash at all. These non-cash transactions are important, but they are not reported in the main body of the statement of cash flow. Instead, they must be disclosed separately, usually in the footnotes or some supplemental schedule. And common examples include buying a building with a mortgage or converting bonds into stock. These transactions impact the company's financial position, even without a cash exchange. Because there is no cash involved, they are not going to cash flow statements. Instead, they disclose in the footnotes or separate schedule. Now let's do some practice question to solidify everything what we are talking about. Okay, so let's tackle our first practice question, a classification challenge that tests our understanding of cash flow activities. Okay, so this question asks you to identify which of the listed transactions are classified as financing activities under US GAAP. Okay, so remember, the key here is to distinguish between operating, investing, and financing activities. Think about how each transaction impacts the company's long-term debt and equity. And pay close attention to the distinction between the interest and dividends, as this is the common exam trap. Okay, so I got much faster than I was expecting. Okay, so here's the solution of the first practice question. So the correct answer is B, meaning only the dividends paid are classified as financing activities. We just talked about it, so I assume you all knew the answer correctly. So how crucial is to differentiate between the type of cash flow activities? Let's break down why. Interest paid on bonds is an operating activity because it's a cost of borrowing. Receiving dividends from investments is an investing activity as it relates to returns on assets. Purchasing equipment for cash is also an investing activity as it involves acquiring long-term assets. Only paying dividends to shareholders directly impacts the company's equity structure, making it a financing activity. This distinction between interest and dividends is a frequent exam trap, so be sure to master it. Now let's do a calculation question. Our second practice question focuses on investing activities. You are given several cash transactions and asked to calculate the net cash provided by investing activities. As we just discussed, investing activities relate to the acquisition and disposal of long-term assets and investments. And carefully consider each item and decide if it belongs in the investing section. And remember to exclude any transaction that could be related to financing and operations. Take a moment to work through the numbers. On the next one, we will do it together. Okay, let's review the solution together. The correct answer is C, $70,000. We focused on identifying investing activities. Now let's see how we calculate the cash flows. The sale of the building and the collection of a loan principal are cash inflows from investing activities. The purchase of equipment is a cash outflow for investing. The purchase of stock is a financing activity because it involves transaction with owners and affects equity, not long-term assets. So we add the inflows and subtract the outflows for investing activities, and then to arrive the net cash flow. Okay, so this highlights the importance of correctly classifying each transaction before you start the calculation, because if you look at the other options, If you include them, you would get a number that would make you feel very confident because it is also usually one of the options. Okay, so let's do our third practice question. This time it focuses on financing activities. Okay, here you presented with a list of cash flows and asked to calculate the net cash provided by financing activities. As we learned, financing activities involve transactions with owners and creditors that affect the company's debts and equity. Okay, so carefully go through each item and determine if it impacts the company's financial structure. Remember to distinguish between interest and principal payments, and between the dividends received and the dividends paid. Once you are ready, let's do the answer on the next slide. Here's the solution to our third practice question, focusing on the financing cash flows. Okay, so the key here is to correctly identify which transactions belong to financing activities and which ones do not. We start with the issuance of stock, which brings in cash, and then subtract the cash paid for dividends and the repayment of bonds. This gives us net financing cash flow of 35,000. Remember, interest paid is an operating activity, not financing, even though it relates to the debt. This is a common exam trap, so be sure to distinguish between the interest and the principal repayment. The final amount is 35,000. Let's recap the critical differences between investing and financing activities. For investing, think non-current assets, buying or selling property, plant and equipment, or investing in other companies, stocks and bonds. Lending money is also investing activity, but only on the principal amount. On the financial side, we are looking at debt and equity. This includes issuing or repaying bonds and transactions involving your own company's stock and paying dividends to shareholders. Keeping these categories clear will help you avoid common errors on the exam. It's about understanding the source and use of cash related to the company's capital structure and its long-term assets. Now that we covered the indirect method and the classification of cash flows, we are ready to move on. Next, we will dive into the direct method of preparing the statement of cash flows. We will learn how to calculate cash flows directly from the T accounts, focusing on items like cash received from customers and cash paid to suppliers. This will give you another perspective on how to convert accrual basis information into cash flow data. Thanks.